Hello everyone, Bhavik Chokshi here. Today's video is just a very short video where I want to just clarify the two questions on deferred tax which are linked to consolidation. A lot of students have posted queries on this. This is pertaining to deferred tax on investment in subsidiary and associates and JV. Case in point is the test your knowledge questions 2 and 3 which are there on page 12.59 of your study material. We'll just directly go to the concept. So over here we are trying to figure out whether we need to create any deferred tax on investments that are happening in subsidiaries, in associates, in joint ventures. Why does deferred tax come into the picture? If you look at investment in associates, if you look at investments in joint ventures, they are accounted using something called as equity method in the books of accounts. So under equity method, your share in the profit is added and dividend, if it is distributed, is deducted. So any share in your profit. So let us say if there is investment which is made at the cost of 1,000 rupees and during year 1 you have earned a profit worth 100 rupees. Under carrying value of investment, your carrying value will become 1,100. This will be your carrying value of investment in the books of accounts. Ideally, if there is any dividend which is distributed, that dividend will be deducted. So if there is any dividend distribution, we deduct this. Let us say we do not distribute any dividend. Then your carrying value in the books of accounts will continue to be 1,000 plus 100, that is, let us say 1,100. Now, income tax does not remeasure the investments based on undistributed profits, and hence unless otherwise given, the investments will be recorded at cost only, that is 1,000 rupees, and hence there will be a difference. There will be a difference of 100 rupees. Now the question is it a temporary difference? Well, it is temporary because eventually once dividend is distributed, let's say in the next year dividend is distributed, so less dividend being distributed, your carrying value will fall and it will again become 1,000 rupees. Let us say income tax, we had not increased the value of investment for the dividend, and hence once the dividend is distributed will not have any impact on the value of investment. So over here the difference is temporary, but the question is, will this difference result in creating a deferred tax asset or a deferred tax liability? As you guys would have been aware by this stage, if it is a taxable temporary difference, which means it results in higher tax in the future years, then it is considered to be a taxable temporary difference. On the other hand, if it is resulting in a tax deduction in the future years, it is a deductible temporary difference. Usually, books of accounts will recognize profit earlier. Why? Because undistributed profits are recognized in books of accounts. You would pass the entry investment account debit to, let us say, consolidated P&L, and hence even if there are undistributed profits, they will get recorded in the books of accounts earlier. In income tax, undistributed profits will not affect the value of investment. It will not be recorded in the books of accounts till the time dividend is received. And as a result, under income tax, there would be no income charge now. But when dividend is distributed, income tax would charge DDT in the hands of the companies, and hence company will have to have some profit which is available for tax in the future years. And as a result, usually whenever an associate, a joint venture, and even subsidiary, we'll discuss how subsidiary also gets covered here, will result in earning profits, it will result in something called as taxable temporary differences, on which usually deferred tax liabilities should get created. Now, in case of these transactions, how will the reversal happen? Remember, the reversal will happen when dividend is paid. But the problem over here is dividend being paid or not might be in the control of the parent entity. So if the parent entity is very clear that it does not want to pay dividend in the near future, then books of accounts will keep on recognizing undistributable profits. However, in income tax, there will be no DDT because in the foreseeable future, you do not intend to pay dividend. Companies like Microsoft, they never paid dividend for around 30 years before they started paying dividend. So it might be that you don't intend to pay dividend in the foreseeable future. So in case the entity controls the timing of the reversal. What is a reversal? Basically dividend. So if the entity controls the timing of the reversal, generally in case of parent subsidiary relationships, the entity controls the timing of reversal, and it is not probable that dividend will be distributed in the foreseeable future. So in the near future, we don't expect dividend to be paid. And the reversal is controlled by the entity. It is not controlled by government regulations or any other transactions. The reversal will happen when the dividend is paid, and the entity is particularly clear that in the foreseeable future, it does not want to pay dividend out of its subsidiary. In which case, the reversal is unlikely in the foreseeable future, and hence, in such cases where both the above conditions are satisfied, condition number 1 is when the entity controls the timing of reversal. Usually this control happens in case of a parent-subsidiary relationship. Condition number 2, it is not probable that dividend will be distributed in the foreseeable future. If both these conditions are satisfied, then reversal is unlikely in the near future. Then there is no point creating a deferred tax when you kind of think that the deferral is not going to lead to a conclusion in the near future. So standard says, as an exception, no DTL should be created. Generally in an exam question, this will be in the case of subsidiaries. Now students might think that we don't really follow the equity method in case of subsidiaries, but remember, even in case of subsidiaries, we follow the line by line consolidation. So if 100 rupees has been earned as profit, your net assets would have increased by 100 in the post acquisition period, and hence probably bank balance, building, etc. would have increased. And correspondingly, consolidated P&L share of the parent's profits would be recorded. And as a result, even in subsidiary, in the consolidated accounts, you will end up recording consolidated profits on the subsidiary. In income tax, it will not be recorded till the time dividend is distributed. And as a result, in case such conditions are not satisfied, remember even one of them, there might be a parent-subsidiary relationship and the parent is committed to giving dividend in the near future, then reversal is likely. Or in case of an associate relationship where the parent or the investor does not have any control over the dividend which is going to be paid by the associate company, in such a case there is a difference, and the difference can reverse. When will it reverse? Well, it is beyond our control, and there's no reason to believe that the reversal will not happen, and as a result DTL will be created for the difference. From an exam perspective at this stage, in case you get a question which has a subsidiary, generally DTL will not be created unless the question tells you that it is probable that in the foreseeable future dividend will be paid. In case of an associate and in a joint venture, we will not even look at the possibility of foreseeable payment because we don't control the payment of dividend. Are we getting this? Yes, okay. So based on this, we'll try to quickly go through the two illustrations and then go to the remaining part of the theory. So the two illustrations that we are discussing here is illustration number 2 and 3. On 1st of April 2011, this is on page 12.59 of the new study material. On 1st of April 2011, ABC acquired 100% shares in XYZ for INR 4373, which means this must be the cost. By 31st March 2005, XYZ had made profits of INR 5 crores, which remain undistributed. If they are undistributed, the net assets are higher by 5 crores. At the same time, your consolidated P&L would be higher by 5 crores. We are owning a 100% stake. Based on tax legislation in India, the tax base of investment in XYZ is its original cost, unless otherwise your income tax does not follow any such methods of consolidation. Assume dividend distribution tax rate is applicable as 15%. So ideally, if we follow the regular method in question 2, you will first try to find the carrying value. In the books of accounts, this is 4373 plus 5 comes to 4378. Second is the tax base. I'm just doing it in short. Tax base, question clearly tells you it remains the same, that is 4373, and hence there is a difference. And hence there is a difference. How much is the difference? 5 rupees. The difference is 5 rupees. This difference will result in a deferred tax or not. We will first see whether it is a taxable temporary difference. Yes, it is undistributable profits. It is undistributed profits, which means the carrying value in the books is greater, income tax is lower. Books has recorded profits earlier, income tax will record it later. And as a result, it is a taxable temporary difference for which ideally a DTL should be created. However, if it is a 100% stake, it is a subsidiary. If it is a subsidiary, we need to check that whether do we control the timing of reversal. Yes, in the first instant, there is control over the timing of reversal. In the second instant, is it foreseeable that reversal will happen in the near future? Is this foreseeable that reversal will happen in the near future. Well, no information is given in the question. So if you assume that it is foreseeable that dividend will be paid, then DTL will be created. If you assume that dividend will not be paid in the foreseeable future, then no DTL will be created. So over here, if we look at the institute's question, it does not really say that whether dividend is paid or not, in which case ICAI has assumed over here that no DTL will be created on the presumption that dividend is unlikely to be paid in the foreseeable future. Are we getting this? Just remember that. I'm just trying to do it fast so that we save time. Second, ABC acquires a 50% stake, which means, is it a subsidiary relationship? No. On 1st of January for 1000 crores. On 31st March, PQR had profits of 50 crores, which remain undistributed, which means your carrying value must be higher. Based on tax legislation in India, the tax base is the original cost, and assume the DDT rate is 15%. So in such a case, let us say we try to do this in blue pen, that is question number 3, we can do it faster. So let's say in the books of accounts, this is 1000 plus 50, and as a result, this will come to 1050. In the books of accounts, this will be 1000 plus 50 equals 1050. Under tax base, it continues to remain 1000 only, and hence there is a difference of 50 rupees. Now, does this difference result in a temporary difference? Yes, because when dividend will be paid, this 50 will no longer be there, and your carrying value will come back to, let us say, 1000. So the difference is temporary. However, does it necessitate creating a deferred tax? Well, it entirely depends on whether you have control over the entities, dividend policies. With a 50% investment, you do not really control that. And as a result, well, you do not control the timing of a reversal. After that, whether it is dividend is probable or not, the exception does not apply, and hence DTL to be created. At what value will DTL be created? Well, DTL will be created at the difference, that is 50 into 15%, that comes to 7.5. Why do we create the DTL at 15%? Because the reversal, if and when it happens, will be taxable at the rate of 15% DDT and not the corporate tax rate. Are we getting this? Yes? Okay. So that largely takes care of the 2 questions that are there in the study material. Apart from that, there is this one extra point which is there in theory, and I've just written down. The theory is available on page 12.33 up to 12.35 if you have time to read that. When will there be a deductible difference? Ideally, if it is an undistributable profit, carrying value will always be greater. That is, value in the books will be greater. However, if there is an accumulated loss, then in the books of accounts, your carrying value will keep on falling, but in income tax, probably your tax base will remain the same. And as a result, this will create a deferred tax asset. But when will a deferred tax asset be utilized? Well, if you end up getting some tax benefits out of it. So over here, there is a necessity of a sufficient profit being available. If there is sufficient profit, that is when you can utilize the tax benefits. And at the same time, the reversal should be probable in this case. So if a reversal, that is a dividend is distributed, that is when the reversal will happen. So over here, in such a case, if a reversal is probable, DTA is created. If it is not probable, DTA is not created. Okay, so that largely takes care of it. I've just tried to do it very quickly because we're just 2 days away from your exam. Wish you all the very best. Do well. Thank you very much. Good luck.